This is something that I will never, ever forget. I applied for a $25,000 business credit card and a $25,000 BLOC at Bank of America for one of the very first companies I had. And I did get approved, but I only walked out with like $7,000, even though I applied for 50. And I was definitely devastated because I didn't understand why I only got approved for 7. I prepared, I scheduled, I went into the bank, I made sure my credit was good, made sure I understood, okay, I gotta say I make 250 and this is what I need to get the approval, and I'm a consultant. And I just find that hundreds and thousands of business owners that we meet with, like people that we've actually met with in person, are losing so much money in funding that they qualify for just because they're making the same mistakes I made when I started in my journey. So I didn't know what an NAICS code was. I didn't know what a business consultant was. I didn't know what the bank is tracking or looking for as a red flag to limit or minimize how much funding you get. All I knew is that I had an 803 and that I had a business. And I was told by my mentor at the time that it was wash, rinse, repeat, to go in, say the thing, and once you've done the deed, you'll get the bag. And that was not how it actually fell, like in terms of the pieces. And so that lesson actually cost me real dollars. It actually cost me real time. And what I want to break down in this video is everything that I've learned since. After now having built a system that has funded over 1,000 clients, after now having built a system that we've put over 1,800 days into it, that's 5 years of day after day, a relentless application submitting, relentless pursuit of excellence for our clients. Like, real quick, skinny, the order in which you approach banks is not a detail. It is the strategy. And most people have never been told that strategy exists. So you do what mostly everybody does, what I did, which is approach a bank as if they're sweet, as if they haven't been making billions of dollars year over year for as long as banks have been around, which is like a century. It's like if you've never been told how to do a thing and you don't know how to do that thing, do you think you'll do less of that thing or more? Here's what's actually happening every time someone applies to a bank without understanding sequence. Every application that does not result in an approval leaves an inquiry on your credit report. And that inquiry will signal to every other lender that you're out there searching for capital. Banks see it, algorithms read it as a risk indicator before a human ever even touches the application. And once those inquiries start stacking, each subsequent round starts from a weaker credit file position than the one you did before. Great example of this is the score ranges from 300 to 850. That's 550 points. If you have 550 points, 35%, 30%, 15, 10, and 10. That's history with payments. That's utilization. That's age. That's new accounts and mixed credit. If you get one late payment, that's 35% of 550 points, 192 points. If you get maxed out cards on your file, that's 162 points, 30%, 550 points. So not only are inquiries stacking, but with a new account, let's say you max out a card or get a late payment, you're positively, like indubitably affecting your file strength and position. And so you might not understand why you got denied or why you got approved for a low limit like I did. And then you just keep doing what you already did and you get lesser results and then think funding doesn't work. See, most people don't realize that this is happening until the damage is done. So you'll apply to 3 or 4 institutions. You'll collect a series of denials or lower limits. Then you'll assume you don't qualify and walk away from capital that you were already positioned to access. And then 6 months goes on and life pulls you on that way, this way, that. Guess what? The problem was never solved. The problem was never the file. The problem was the sequence and the info that you were operating from. Here's the layer underneath what most people have never been taught. Banks have preferred relationships with specific credit bureaus. So that means that a bank will pull exclusively from one of the 3. Some pull TransUnion, some pull Experian, Equifax, and that one variable changes everything about how you should approach a funding strategy. So you might have one credit bureau that's completely clean, no negatives, solid history, strong limits, but you might have another bureau that has a late payment or a collection sitting on it from 6 years ago. And if you don't know which bank pulls from which credit bureau, you'll apply to an institution that pulls from the lesser, and now you're handing them a denial to hand to you before the convo's even started. Meanwhile, there are lenders that could have approved you based on the clean bureau if you had approached them in the right order. And I want to make this concrete. So GM recently opened a new business credit card, 2026, that pulls from Equifax. So if your Equifax is clean and your other bureaus have issues, that's a lender that you should be building with, relationship or application wise or any sort. You should be building with them. But most people don't know that GM offers a business credit card at all, let alone which bureau it pulls from. And it's not info that you can Google or ask in a mentorship to get accurate info, because everybody's in a different state. People have different credit reports than you do. So what a bank might need to come to a underwriting decision for a different person might be separate than what the bank needs to come to an underwriting decision for you. And to be clear, the information does exist. It just isn't widely taught because the people that have it treat it as their competitive edge. And we teach it because the rules of this game work for everybody that has credit vis-a-vis you. And so we want you to understand it because it's your right. It's the gift and the talents and the skills that you've been given to make a name and make a way for yourself in this world. So it's not just people who happen upon the info or who pay for the info that should get access to it. It should be everybody that has that algorithmically created score. So let me walk you through exactly what the correct sequence looks like from the first application to the final round. So you start with national banks. So that's Chase, Bank of America, US Bank, Truist, Wells Fargo. These are the highest limit institutions in the system. You go to them first for one critical reason that most people just aren't told. Have thresholds that are higher than most. So you can get 100K from Chase before they ever ask for a financial document. And Chase doesn't want to see inquiries on your file, right? They want to be the first and primary relationship. And if they see that you've already applied elsewhere, that signals to them that they weren't your first choice. And some of them will deny you on that pattern alone. So we go nationals first because they have the highest thresholds. They have the largest lending limits. They have the best promos, the lowest interest rates, the best rates overall. And you want to go to them before you go anywhere else. We call that low-hanging fruit. Before any other bank touches your credit report, you want them to. Wells Fargo, very similar. Different requirement worth knowing. They want relationship before you apply for anything. Credit card, business credit card, loan, business line of credit, it does not matter. 2 months of relationship first. If you walk in on day one and you apply, you've skipped a step that they require, you will fail. So open the account now, let 2 months of relationship build, and then approach them. Now, if you are one of the select few that opened the account, applied, and got approved, shout out to you. You beat the system once. Chances are that's not a replicatable process. Big idea, everything you do at one bank, replicate the process. So if you're establishing relationship with Chase, also establish relationship with Wells, right? If you're thinking regional institutions, so AKA round two, KeyBank, M&T, Citizens, banks that operate in specific states and regions. These lenders have different criteria, different products, different approval thresholds than the nationals. However, establishing relationship is the same exact process. So what you do with one bank, do with another. Where the caveats come in is that some banks have specific products for specific business types that other banks don't offer. Knowing which regional bank fits which file is part of what makes funding sequences work. And then the third round is that you go local. So credit unions, community banks, and by this point, you're just accumulating approvals. You're also accumulating denials, of which should give you data to know where to go back after time has passed. Go to the denials. The goal is to have as many real banking relationships as possible, because the more relationships, the bigger the network, and the bigger the network of business partners, the more you can borrow to invest in businesses that produce cash flow and equity and value for you. And then the bank loves that because then that means you got money. And if you got money, you can use money. And if you use money, you can pay money. So you want to build that network because that's what makes the next round of funding always faster, larger, and more accessible than the one before it. And between every round, inquiries. And inquiries should come off. And that step is non-negotiable. You apply in round one, you stack the inquiries, you remove the inquiries, you prep for round two. Round two comes, you get the inquiries, You remove the inquiries, you get ready for round 3. This cycle is ultimately what allows you to compound across rounds without your credit file deteriorating between applications. It's what takes a $50,000 first rounder and turns it into a $150,000er by round 3. Okay, most funding companies don't do a round 2 or round 3. They get you through the first round, they collect what came in, they send the invoice, they call it done. Most of the industry does stop right there. So we run our clients through a 3-round sequence. That's 20 banks per round. So round 1, 20 banks, round 2, 20 banks, round 3, 20 banks. So 60 bank funding sequence. And that's the difference between a transaction and a system. So we work with a client, a wholesaler with a solid score, real business income, consistent transaction history. And on paper, he looked like someone who should be getting approved. But he had a derogatory mark on his file. On his lonesome, had been applying repeatedly to the same institution, which was pulling from that same credit bureau. And every application was denied. Every denial was an inquiry. And every inquiry made his life in funding harder because every new application started from a weaker position than the last. And so he's stuck in this loop, and real deals were showing up that required real cash money. And those deals died. And that's not a credit problem. It's a sequence problem. I want you to get your sequencing right so that you know what institutions to go to and you know where they pull from, so that you could produce a different outcome even if you have worse credit. Now, the second example, we had a client who was already operating at a sophisticated level in business, serial entrepreneur, over $500,000 in funding that they already got. So by most measures, they figured out the system. But he had a stupid rule, quiet rule, that he had been operating by his entire career. And it was a limiting belief. And that belief was that I never will use my personal credit for business purposes. Business credit. And that rule was leaving 6 figures on the table for him every single time he went for funding. But the rule came from a bad place. It came from the belief that keeping personal and business was the responsible way to operate. But it was capping him at a ceiling that he didn't know existed. And so every cycle, he's leaving more and more, a significant amount of available capacity untouched because of a belief that nobody ever challenged. And when we layered a properly sequenced multi-product stack, business lines of credit, business credit cards, personal credit, personal loans, alongside what he already had, he moved from $500K in funding to $900K. The man almost got $1 million in funding, the same person. Same businesses, same credit file. The only things that changed were the sequence and the removal of a self-imposed rule that had been blocking multiple 6 figures in funding every cycle. That's what invisible ceilings look like. They're not always in the credit file. So you might be getting denied, or you might not be getting the traction you want and not know why. Sometimes it's the beliefs about what the credit file is supposed to do or allowed to do. Gotta check that. Most people don't know about bank sequences. Banks don't just like publish which bureau they pull from openly. And the info changes. It changes annually. A bank that pulled Experian last year may pull TransUnion this year. And the only way to stay current is to actively run the sequences across enough clients to track the patterns in real time. And we do this across 1,000+ clients that we've built relationships with, that we've walked in their entrepreneurial journey with them. Most people apply for funding and they do it guessing. And then every guess that comes back wrong is like a slap in the face that delays growth to the goal. And I think about the version of me that walked into BOA with my business application and my little ego and confidence and told them I did real estate and applied for $50,000 and then walked out with $7,000 instead of $50. Not because I wasn't qualified at 800 credit score, but because I did not understand the rules. I did not know which institution to approach first, what my entity structure was signaling to them or to underwriting before they even looked at this score. I didn't know that the order that I was approaching banks in mattered. The version of me back then is who most business owners are right now. And nobody's giving these business owners a map. I believe that paper, like receipts and documentation, beats promises every time. And that's a lesson I learned the hard way through everything that has happened before excellence. And it does apply here too. It's not enough to know that funding is available. You have to do the things that are necessary to position yourself for it. The sequence is the strategy. Everything else is a detail inside of it. If you have a real file If you have real revenue, 20, 30, 40, 50K a month, real business, and you're still getting denials and you don't understand why, the sequence is almost certainly why. It's not your score, it's not your income, it's the order in which you're approaching banks. And whether your file is in the right timing with lenders, as is. Your sequence is not a small thing. It is the difference between a funded file that compounds year over year and a credit report that just gets burned with denials that you didn't have to have month after month. Links in the description. Get the free roadmap. See how your file actually reads to a bank.